Andrew Holland needs no introduction. He's here with us at the moment. Thank you so much for joining us, Andrew. Let me start off by asking you a very tough question. What are you doing right now in the markets? It looks like everything has run up and very difficult to buy anything.
You've hit the nail on the head. It's very difficult to find any value in this market right now on what is it, 19 times 1 year forward. So momentum, liquidity globally is pushing markets higher than we probably. It always happens, right? It always goes a little bit higher than you expected. So if you're struggling now to find value, then obviously something will change, and I think we'll see valuations or markets going to have to consolidate around here, because there's no, even from the earnings season, whilst at best the leading companies are kind of in line, we have seen some negative hits as well. So I think the analyst community after last quarter kind of got more excited about the earnings growth. I think that will be tempered again. So I just can't. You kind of said what I was thinking, in that I just can't find anything to buy at the moment.
I've noticed whenever this happens, that the markets get overvalued, more expensive than what they should be from fundamental investors. Ambit's team comes up with some, what do you call, the coffee can approach. You have some little giants that you focus bottom up. Is that still a possibility? To look at small cap companies, look at really smaller mid-cap companies and have a bottoms-up approach, because they've been delivering and they're still not too expensive. I mean, probably they weren't too expensive 3 days ago. They're moving up so fast, one doesn't know.
Yeah. Well, actually, that's from our equity broking side. That's, as you know, I run the fund management side. So, we don't, in our fund anyway, we don't really look at small and mid-cap companies. But there was value a month or so ago in pharmaceutical sector. After all the FDA kind of inspections and rulings, we felt that sector was ripe for a re-rating. We think that re-rating's just started, so we think there's a lot more to go, and I think there'll be a switch from the IT sector back to the pharma sector now. Going forward, and we think the worst is over for the pharma sector in the very short run. So, re-rating, and obviously, good strong earnings from the pharmaceutical companies over the forthcoming year will push prices higher. But that's really the only area that we're seeing some value at the moment. So, we're not kind of saying we're selling everything, but certainly we're not adding to existing positions at the moment in other sectors, because valuations. The risk is too high at the moment, I believe.
That one up, you said that money's going to go from the IT sector to pharma. Do you think the Indian IT story is more or less over?
It's been over for some time. I mean, that decade of growth I've spoken about this before is gone now. And if anything, it's going to become more and more competitive. It's been more of a commodity-based business, and therefore I can't see why I'm paying such a rating for commodity type businesses. Also, I think the Brexit decision will have an impact on hiring decisions across Europe, and I think again that will affect the IT companies. And of course, we have the elections in November in the US, and that's never a great time to be in IT companies with all the noise around visas and so forth, which I'm sure will come out. So we think it's a sector to avoid, but we've been feeling like that for some time now.
But if I look at the multiples that IT companies used to enjoy almost, let's say, 7-8 years ago, they have obviously got derated. They all now trade, even on a good day, they trade at, let's say, 18 times 1 year forward or something like that. But before that, we've even seen times when they've done 25 times because of the high rate of growth they had. That has derated. But you were talking about IT now becoming a commodities business. Essentially, the cheaper it is, the better you're going to be. But, when I look over a commodity like, let's say, aluminum, it has cycles through which it goes. There's an up cycle when you buy aluminum again, companies across the world buy it. But it appears now that what Indian IT does is not even a commodity, because it's going to be replaced by new kinds of technology which will not require Indian IT's arbitrage anymore at all. So it's not even a commodity in that sense. It's like a typewriter.
Yeah, I'm just trying to think back to typewriters. Again, you're right in what you're saying, and I think the way I think about IT companies at the moment is that as new technologies come through, you've seen all the management changes across the different IT companies, and obviously they're all struggling to get a business model now which is is going to work for them, and some quarters it's kind of worked okay. And then the next quarter you see it kind of slowing down again. I question how many say the financial industry, how many times are they going to restructure and outsource their business? I mean, it's just not going to happen to the extent it did over that decade or so before. So you're right. So I'm not sure what rating they should be on, but until they get more towards the kind of 10 to 12 times PEs, then that's the time I'd probably look a little bit closer. Obviously they're throwing off cash and there's nothing wrong with that, but they're not doing anything with that cash. It's not as though they're paying me a big fat dividend, or there's a dividend yield that I can get excited about. So, maybe commodity utility type valuations is where we should be looking at them if they start paying dividends, or giving shareholders their money back. Because the growth is not there that they enjoyed so many years ago.
So I just took two. I started off with two sectors which have. I understand you can't stock, so we're going to just stick to sectors. I took two sectors which are exposed to the global markets, right? And then we have something which might not be directly related to the global market, but has some impact, which is financials. The reason why I'm saying that is because when you have interest rates going down across the world and negative interest rate regimes, financials in India are going to be affected as well. There has been a big jump in PSU stock valuations in the last 2 to 3 months. We've seen that the markets couldn't find anything and they put money in PSU banks. Are you bullish as well? Do you think that it's worth putting your money in PSU banks? Or have you put your money in PSU banks? Better question, I guess.
Okay, so I'll go back to what we always say about PSU banks. We don't mind renting them when markets are kind of moving higher, and that's what we've done in the past, and we'll continue to do so. But we don't want to own them for any considerable period of time yet. So what you always see is, as the banking sector has its day in the sun, PSU banks trade at price to book at 0.4, and will go up to 0.8, a little bit higher, and then come all the way back down again, because the fundamentals are still not there for the PSU banks. And we just look at what HDFC, Access, and the other leading banks have said. They're under pressure, so I can't see that the PSU banks are going to be any less under pressure going forward. And even if the economy does start to pick up after the monsoons, they're just not in the position to garner market share, and they're losing market share not only from the private banks, but also from NBFCs as well. So they're really caught up in nowhere, in no man's land. There's no new management going in, there's no new capital going in. So it's like you're just living on hope that something changes for them. But I don't think hope is a strategy, so I don't think we want to be. Well, we haven't invested, and we don't have any investments in PSU banks.
All right, you did mention that at a time when
changes.
At a time when the HDFCs and the Axis and the new age private banks are in trouble, or no, trouble might be too extreme a word, but facing problems, PSU banks, obviously the situation would be worse. Are you a little surprised and concerned by the way in which we're seeing the kind of asset quality deterioration in the private banking space?
No, I mean, it's not, I think what we tend to do here is that, we take the market barometer as being that everything is okay and everything's recovered. And all you've had really is because of the government here and other places as well have been putting import controls or price controls on areas like steel and metals, which has kind of helped those companies from the competition from say China in the very short term. But that doesn't take away the fact that these companies really haven't done anything themselves to restructure, cut costs, to start building a new business. So that's why the banks are finding that they're just owning assets or have borrowed to companies or lent to companies where the free cash flow is just not there, and it won't be there for some time. Therefore, it's a deteriorating asset because there's many problems out there for these companies. So I'm not surprised, and I think the only thing I was surprised about was the banks themselves saying that the worst was over maybe a quarter or two back, when they said we've covered all of these companies. So I think maybe they in a very different way. When the Bank of Baroda chairman first came in, he said I'm done. I've done all of this, and then a quarter later is even worse. So I think the problems in the banks are probably a lot more than they're letting on at the moment.
And I guess the banks, the problem is also that they're in a bit of a dilemma. That should they lend to the corporate sector to risky assets or create risky assets, or should they just hold back? It's a bit of a problem. How do you deal with that right now, right?
I think that's not just for India. I think if you look at that globally, despite the low interest rates, banks globally are just not lending to anyone. So everyone's being very choosy on the assets they want to, or the companies they want to lend, to, and therefore what happens in this environment, it starts with the big companies and then slips to the kind of small and medium-sized companies who themselves will have cash flow problems. So it all kind of feeds itself, and this is what you're starting to see. I think Canara Bank yesterday, kind of hinted that it's the small and medium-sized, companies which are causing problems for them now.
Now, so that brings us to the question of consolidation and asset sales. We've seen that happen, and I've just been reminded by my executive editor, Vichitra Salotra, that you do talk stocks, and therefore I must prick your brains on those as well. We've seen these asset sales that have taken place. Some of those asset sales appear to be at decent valuations, and then the next round comes, you see that it's actually a much lower than what the markets expected. Now, this is obviously because someone who has a distressed asset, he has to sell it to pay back, and they're selling it at a lower price. What this is leading to, unfortunately, is a sense of debt deflation in assets. That's a double whammy, isn't it? I mean, you have given a loan to a guy, and you're telling him, please sell your assets. The only assets that chap can sell is the ones which are productive, and since it's a distress, he has to sell them at below market price, and you've given that loan, he's going to return, he can't return you as much as you lent him. And after pushing asset prices down, someone who's not even distressed, his asset prices have gone down suddenly. His entire valuation is affected.
Yeah, I'm not sure that that's the case actually, because for a company which is not under any stress to sell any asset, doesn't have to do that, and you're always going to get, let's take the housing market for example. You're going to get, you'll hear of things, someone sold an apartment at this distressed valuation, but that doesn't mean that the whole of the building goes to that. They're just
no, but you do. What does happen is that you think that, okay, I have this house and it's worth 10 crore rupees. So you feel, wow, I have 10 crore rupees if I need it. And then you hear that the next house actually was sold for 5 crores and you think, oh my God, is my 10 crores actually worth 5 crores? I'm saying that the valuation that maybe someone puts out on a spreadsheet, an analyst, and they say, okay, this is the land bank, this is the replacement cost of the per megawatt of power that this company has, that is output, and suddenly you see that the replacement cost has dropped by 20%. So you're going to bring down that valuation, right?
No, well, I would doubt that the analyst community would do that so rapidly, because again, if it's a distressed sale, not everyone's going to be distressed to sell, right? So it's good for the company buying that asset, but obviously, if I was an analyst, I would not kind of just take my red marker pen out and say, I'm going to devalue this. But anyway, I wouldn't have thought that, unless you're buying something on a you know, on a holding company basis where you're valuing each of the assets,
Right.
then you know that's a sum of parts equation
Yeah,
anyway.
yeah. I fear that every time the markets go up and you can't find a way to value a company and justify that valuation and say it's still cheap, then you come up with some sum of parts, possible demerger and things like that. We've been seeing that for the past 10 years. That's why I was pointing that out. But nevertheless, I take your point. The other point, Andrew Holland, of course, is that when you have stressed assets, you see consolidation. So if I look at the big cement players, I look at someone like a JSW Energy, it has the money to go out and buy things. It has the leverage. It can leverage because it has a decent balance sheet. It leads to consolidation. But the first reason why those assets were stressed, or maybe the part of the reason, is because there was overcapacity. The person who built an asset doesn't have buyers for what he produces. Now, when there's consolidation, isn't that overcapacity simply moving into a balance sheet which was strong?
Yeah, so it doesn't take away the overcapacity, obviously, but as the economy, so if you're the buyer, let's say an Ultratech has recently bought some assets, right? Maybe it can increase the pricing because it's a different brand than the brand that was named before.
Yeah.
But two, as the economy picks up and as prices move higher and your capacity utilization moves higher, then you reap the benefits from operational gearing.
Right.
So that's where you get the consolidation. I mean, obviously, for some of these companies, you know, cement was never really or should never have been part of their business, right? And so therefore it was an asset they had to sell. And so the consolidation within the industry is actually good news rather than it's bad news in this case. So I heard what you say about the overcapacity, but you know, that was because you had certain elements or certain companies in there who probably shouldn't have been in that industry anyway.
All right, that brings me to the question where I would like you to be stock specific. Would you buy Ultratech?
Would I buy?
Ultratech. You mentioned that Ultratech buying assets, it's actually not bad. It might have current overcapacity, but it has the specialization, it gets operational gearing when demand goes up. The fact that it bought more assets, there's consolidation, would you buy Ultratech?
Well, we already hold it in the portfolio. We've held it for some time. So
would you add?
But, would I be chasing at this stage? No, I wouldn't be chasing. I wouldn't be chasing anything in these markets at the moment.
Okay.
As I said, the only thing we've been buying a little bit more aggressively a month ago and added in the past few weeks as well is in the pharma sector.
In the pharma sector. Now, obviously, being a fund manager depends on the way in which your funds are structured. At a time when markets go up, do you get a lot of demand, people coming in and saying that I want to invest?
So ours is a long-short fund under the AIF Category 3 rule. So, you know, it's obviously the minimum requirement there is 1 crore. So we don't have people rushing in that respect. But obviously the assets have grown very strongly. We're over nearly 1,100 crores of assets under management now, the largest long-short in India. But you know, obviously what we try and do is look at these valuations and try and hedge. You know, for possible downward corrections, not just for Indian markets, but you know, considering global markets.
You
as
can
well.
be on cash if you want to be.
I can be.
In cash, you can take out and just sit on cash.
Yes. So you know.
And are you doing
so
that?
for example, no, not necessarily right now, but in same February, January, February, when markets were, you know, hitting all-time lows, not just here, but across the globe, we had a high level of cash there to protect our clients' money.
So it's clear that you don't see any valuation here, but let me try and get this sense that you were saying that once the economy picks up, things will look up. And I'm actually back to asking these questions on NDTV Profit almost 2 years, after 2 years. And 2 years ago, I spoke to you. And I don't know if I want to sound rude, but you did say the same thing, that as the economy picks up, things will look up. It didn't pick up. So is there any...
No, you're absolutely... No, you're absolutely right. I mean, after Modi came in, the expectation was that the government would spend money in the infrastructure sector, that would have a multiplier effect, and you know, the domestic India story, which is all about operational gearing, would play through. That obviously didn't happen, and it's only just happening now in terms of the spending on the infrastructure. And I think the problems that companies faced, particularly in the kind of metals and oils, you know, at that time was probably not as severe as we were thinking it actually turned out to be. So that took the banking sector down, and so forth and so on. So, you know, here we are, you're right. What are we hoping for? We're hoping that the monsoons are okay.
Yeah.
Obviously, the 7th Pay Commission will come. I mean, you know all of this. Everyone's been talking about it.
Yeah.
And that will be hopefully the kicker for
I just wanted
profits,
to know how seriously you take that, because, you know, whenever we ask analysts, and it's almost something that everyone says, that monsoons will lead to consumption growth. I had one fund manager come in the last 15 days who said that I don't think it's going to lead to immediate consumption growth, because the first year of a good monsoon, farmers tend to pay back their debt which they've accumulated over 2 droughts, and it takes time for consumption to come back, and that will happen if we have another monsoon. Would you tend to agree with that?
No, it doesn't have. I mean, listen. Well, there's 2 things to it, right?
Right.
For the monsoon and the farmers, I agree. No one's going to rush out and start spending, you know, straight away. But obviously, on the 7th Pay Commission, people will get more money in their pay packets every month, right? Automatically. So, you know, it's a bit like if, you know, you get a pay rise tomorrow and you look at the end of the month and you've got some extra spare, you're going to go and spend it. I'm sure.
But you know, even
so,
there,
you know, that will be the first part.
But even there, if you look at the breakup, and I don't want to rub the point in beyond a point, because I get what you're saying, that even if you look at the breakup on an average, what people are getting, it's not too much. There's been a hike in HRA, and when that hike in HRA happens, you see that government, if you've given a government accommodation, the government takes it back. If you've got if it's known by the guy who's rented his house out to you that your HRA has gone up, he tells you that, oh, you know, I've got these people coming in and they want to look at your house, and you say, no, don't worry, I'm going to give you a 10% hike in rent. So some of that money is actually going to go in there rather than immediately come into consumption. The average that was worked out for us by one of the bankers over here is coming to about 8,000 to 10,000 rupees per month in someone's hand. It's not very little. 1 lakh crores over a period of time. I know that it's going to come in tranches. But if I look at the savings rate, then approximately 40,000 crores come into the system. Is that enough?
Yeah, but you know, I think that, I mean, one of the things that I would say is that, you know, you're just taking a small amount, and then, you know, taking away the animal spirit of someone. If you get more money, you go and spend more money, and that's just human nature.
And in some cases, like me, even if you don't get money, you go and spend more money. Andrew Holland, I understand that you have a lot of NBFCs in your funds, right? And we were speaking to NBFCs, and one of them, L&T Housing Finance, for instance, L&T Finance Holdings, they were pretty cautious. I mean, they were optimistic, but what I'm sure you would have seen it as well. The press release says that we have ceded ground on something which was their key focus last quarter, which is farm equipment, because they didn't think that it will work out to be safe loans. So they're saying safety first, no cowboy banking. So what are you hearing, and what are you doing in the NBFC space?
So we've had quite a number of the NBFCs in our portfolio now for some time, and they've all done exceptionally well. You know, we're taking a little bit of money off the table, to be honest, because, you know, the stocks have run up, valuations are you know, superbly high, and, you know, the risk reward is more in favour of risk than it is reward at the moment. So, you know, it's been a great run. We'll probably just keep trimming a little bit if they continue to move higher, and if there's any kind of, you know, market kind of fall again, which affects these companies, then we'll look to re-enter. But at the moment, not chasing. I said not chasing
anything at all. But you are trimming some of those NBFCs, which some of them are massive, amazingly expensive, one would look at, but probably justified, growing very well. but you're trimming that position, you say.
We have trimmed some, yes.
All right. Andrew Holland, thank you so much. We've taken a lot of your time. Thanks a lot for speaking to us. Pleasure talking to you.
Thank you very much.
Thank you.